On September 17, 2019, the quiet engine of global finance suffered a sudden and catastrophic seize. The overnight borrowing rate inside the United States repo market exploded from a calm 2% to an unprecedented 10% in a matter of hours. Millions of dollars in institutional funding vanished from availability overnight. What seemed like a minor technical hiccup was actually a terrifying heart attack inside the foundation of global banking. To understand the sudden collapse, one must examine the daily mechanics of the repurchase agreement market. Every single evening, massive financial institutions trade trillions of dollars in ultra-short loans secured by United States Treasury bonds. Commercial banks with extra cash lend to investment funds that need immediate cash to settle daily accounts. The borrower pledges top-tier collateral, promising to buy back the securities the next morning with a tiny slice of interest attached. This short-term lending market underpins the secured overnight financing rate, the key benchmark setting borrowing costs across trillions of dollars in global financial contracts. When functioning smoothly, the benchmark rate moves in tiny fractions of a percent, perfectly anchored by the Federal Reserve. But on that quiet Tuesday morning, the delicate equilibrium snapped. Wall Street desks found themselves facing an unexpected shortage of cash, sending the secured overnight financing rate soaring off the charts. The immediate spark appeared simple on the surface. Corporate tax payments were due to the United States Treasury, pulling over $100 billion directly out of commercial bank reserves. At the exact same time, a massive settlement of newly issued Treasury bonds required primary dealers to absorb cash-heavy debt obligations. Two heavy financial drains hit the banking system simultaneously, sucking cash straight out of daily circulation. Yet a routine tax date and bond auction should never trigger an economic crisis. Under normal historical conditions, large money center banks would step into the market, lend their massive excess cash, and harvest the exceptionally high interest rates. Instead, the largest financial institutions sat on their hands, refusing to offer cash even when offered profits 5 times higher than normal. The big banks were frozen by design. The true culprit behind this paralysis was the framework of post-2008 financial regulations known as Basel III liquidity rules. Designed to keep megabanks safe after the global financial crisis, these rules mandated strict capital buffers and high-quality liquid asset reserves. Regulators demanded that major institutions hold vast mountains of cash and treasuries at all times to withstand sudden bank runs. Within these framework regulations set complex rules governing intraday liquidity management. Regulators monitored the cash balances of major banks continuously throughout the single trading day, not just at the final closing bell. Bank treasurers quickly realized that if they released excess cash into the overnight market during morning trading, their internal safety ratios would temporarily drop below mandated regulatory thresholds. Because breaking these regulatory guidelines carried severe punishment from federal examiners, risk officers blocked cash transfers. Bank treasurers chose an absolute safety over lucrative overnight profits. Millions of dollars remained locked inside balance sheet vaults, totally inaccessible to the broader financial system. The regulatory armor built to protect individual banks had effectively paralyzed the entire credit ecosystem. This rule-made trap crashed into a second, much darker force. The central bank was doing something called quantitative tightening. It is a big word for a simple, scary action. They were draining the pool. For years, the people at the Federal Reserve let their giant pile of government loans expire. Instead of buying new ones to keep the money flowing, they just let the cash vanish. Day by day, this choice sucked life-giving cash right out of the banking system, steadily reducing the total pool of actual moving money year after year. Imagine being trapped in a room where the air is slowly being pumped out. That is exactly how the people managing these banks felt. At first, no one panicked. The room was big and the air seemed endless. But as the months dragged on, the breathing room disappeared. The men and women staring at their computer screens felt a creeping sense of doom. The safety cushions they relied on were gone, replaced by a cold, silent pressure that kept growing heavier. The digital reality of this choice was chilling. Deep inside the bank ledgers, the numbers that meant survival were turning to dust. The vaults, once overflowing with extra cash to lend, were completely hollowed out. On the quiet trading floors, the glowing green numbers on the monitors began to flicker. The deep pools of money that kept the whole world running smoothly were drying up, leaving bare, cracked earth behind. Every single morning, bank workers had to play a terrifying game of musical chairs. They arrived at their desks before the sun came up, picking up their phones and typing desperate messages into chat windows. They begged to borrow enough cash just to survive until sunset. They hunted for any spare dollar hidden in the shadows of the system, but the central bank had already quietly swept those dollars away. Federal Reserve officials had assumed the system held plenty of excess reserves to absorb daily market swings. They failed to realize that regulatory rules had turned those reserves into structural cement. The total volume of reserves was officially high on paper, but the actual usable cash available for daily trading was dangerously scarce. Systemic fragility was fully exposed. By mid-morning on September 17th, hedge funds and primary dealers were scrambling for cash to settle their daily balances. Panic swept across funding desks as lenders vanished from the screen. Brokerage firms were forced to bid interest rates higher and higher just to secure overnight financing. The short-term borrowing benchmark detached completely from official monetary policy target ranges. With short-term lending frozen and panic threatening to spill into mainstream corporate debt markets, the Federal Reserve was forced to take drastic action. For the first time since the 2008 financial crisis, the central bank injected dozens of billions of dollars directly into the repo market through emergency open market operations. The central bank stepped in as the lender of last resort to rescue the plumbing of finance. These daily liquidity injections acted as a massive emergency bypass for the short-term banking system. The Federal Reserve accepted Treasury bonds from primary dealers, pumping vast rivers of fresh cash directly onto institutional balance sheets. Overnight rates immediately cooled back down toward target levels, but the underlying structural problem remained completely unaddressed. The event revealed a profound institutional paradox at the heart of modern monetary mechanics. Regulations designed to eliminate systemic risk had created a brand new form of systemic vulnerability. By legally forcing every big bank to hoard cash, policy creators had eliminated the flexible buffers that keep short-term money markets flowing smoothly during stress events. When repo rates spike, the consequences extend far beyond Wall Street trading desks. Every financial instrument tied to short-term borrowing rates, from corporate credit lines to foreign exchange swaps, experiences sudden repricing pressure. If overnight loans freeze, commercial institutions cannot fund their daily payrolls, buy inventory, or bridge temporary cash flow gaps. To prevent a repeat of the September shock, the Federal Reserve was forced to abandon its effort to shrink its balance sheet. Instead of stepping back to let private markets function independently, the central bank permanently established a standing repo facility. The Fed transformed itself from a distant regulator into a permanent backstop for daily short-term credit. The spike also highlighted the dark, complex world of collateral rehypothecation. In shadow banking, a single treasury bond is often pledged and repledged multiple times to back various loans across global institutions. When cash shortages freeze the primary repo market, this chain of repledged collateral threatens to snap, creating a rapid cascade of default risk across global counterparty networks. Non-bank financial institutions like hedge funds had grown heavily reliant on cheap overnight repo funding to leverage their treasury basis trades. When repo borrowing rates jumped to 10%, those leveraged arbitrage strategies instantly became deeply unprofitable, threatening to trigger massive forced asset liquidations across the bond market. Financial history shows that liquidity crises rarely strike where regulators are actively looking. Just as shadow banking defaults caught authorities off guard in 2008, the silent lockup of intraday liquidity in 2019 demonstrated that modern financial engineering consistently creates hidden points of failure. The plumbing breaks precisely where safety rules create unintended behavioral traps. In the aftermath, financial authorities realized that capital requirements alone cannot guarantee financial stability. Regulators were forced to re-examine how intraday liquidity rules interact with central bank balance sheet operations. Yet, despite technical tweaks, the fundamental tension between strict safety mandates and market liquidity remains unresolved. Today, the global financial architecture operates on an unprecedented scale of government debt issuance and central bank interventions. As governments issue trillions in new bonds each year, the demand for short-term collateralized cash continues to surge. The the repo market remains a delicate web where minor shifts in bank balance sheets can trigger systemic shocks. The repo spike of September 2019 serves as an enduring forensic autopsy of modern finance. It proved that in a hyper-regulated world of massive debt, liquidity is an illusion that can evaporate in a single morning. When the invisible pipes of global money lock up, even the strongest banks on earth are only hours away from complete paralysis.